Hey there, Doc. If you're joining for your first time off my YouTube channel, welcome. I'm thrilled to have you here. If you've made it here, it means that you're really ready to engage with some serious learning, and I promise you'll gain valuable insights from today's video as we're tackling the crucial subject of bank account balancing. Today, I want to discuss what I believe is a significant contributor to why I struggled financially for such a long time, and why I also find many millennial dentists to struggle for similar reasons, and I call it bank account balancing. I developed the concept off the book Profit First, written by Mike Michalowicz, excellent author, great business guy. Most of his books focus on business finances with a touch of personal finance. So I've adapted most of his principles to help and to make it more applicable to dentists and personal finance. So here we go. In his book, Profit First, Mike highlights a common pitfall amongst business owners, and that is that they make their financial decisions based solely upon the current balance that they see displayed on their checking accounts. This approach often overlooks future liabilities such as annual insurance premiums or April tax man. In the book, Mike describes a situation where the owners look at their checking account and they see a healthy amount of cash. They then decide to buy a new set of office chairs that they really didn't need. Conversely, when they look into their account and they see a low number, they tend to tighten their belts. They cut out any luxuries like coffee for the office. They become diligent about turning off the lights as they leave each room. Basically, the cycle of financial decision making based solely upon the account balance you see ignores the myriad of liabilities in life's circumstances that tend to arise at the most inconvenient times. Now, let's see how this concept applies to us as dentists. When I first started working as an associate, I'd receive a paycheck. Woohoo! A nice $6,500 or so would hit my account. The next day, I'd log into my bank account. I'd see that large number and I'd think, heck yeah, it's time for a Dutch Bros coffee. I need to treat myself. Yeah, that's right. I don't like Starbucks. I maybe would go out to lunch with the guy I worked with. I'd be on Amazon buying my kids a gift or a new toy, something along those lines. However, just as quickly, a few days later, I'd check into my bank account and my mortgage, my student loan payment, and all my other monthly bills would come out, as well as a surprise bill for my annual malpractice insurance premium. And this would all come crashing in at once. Suddenly, I'd log into my checking account and find a mere $453 left and 10 days until my next paycheck. Panic would set in. I'd have that stomach tightness, and it was time to buckle down. This meant no more coffees, no mall trips, and the meals were going to be good old mac and cheese at home. Kid favorite. What would happen is I'd survive those 10 days, I'd receive my next paycheck, only for the cycle to begin anew. This experience taught me an important lesson. The world doesn't know how much money you have. Rather, I would make whatever amount of money I had in my account work for me. That sentiment is truly the essence of bank account balancing. It's whatever amount you see in the account, you make decisions on what you're going to have, and you're just going to make it work. This is human nature. Human nature often leads us to look at our bank accounts and make our spending decisions based upon what we see. It's challenging to separate our emotions from our finances. And to be honest, and Mike Michalowicz agrees, I don't think we should even try. Instead of trying to suppress our humanity, why don't we focus on a strategy that involves hiding or relocating some of the cash from our own human nature? Here's my recommended approach. Start by creating that one main bank account. It can even be the account you have. This is your catch-all. What's going to happen with this account is it's basically where you're going to receive your payments. So if you get a weekly paycheck, a bi-weekly paycheck, any forms of income you get, they dump into this one account. This is your distribution hub, if you will. Now, within that same bank, you're going to set up two additional accounts. I would set both these accounts up as checking accounts. You can label one of them as bills and one of them as fund money. So you have your catch-all account, you have your bills, and your fund money. These accounts are easily accessible and allow for straightforward transfers when you need to make your bills or indulge in some fun. Additionally, at a separate online bank, the key word there is separate. The separation is what's going to make this step critical. You're going to create two high yield savings accounts. Again, HYSAs. One of them is for taxes and an emergency fund, and the other account is for future savings. I plan to make a video that dives much deeper into why and percentages that will allocate to each one. But basically, those are going to be our accounts that money's always going into, so that when the tax man comes, an emergency comes, or your future goals come, You already had money there, and you're not dipping into your pocket to cover those things. In the comments or through my direct messages, please tell me if you live paycheck to paycheck. It's human nature, and I think it's due to bank account balancing. If you're ready to rid yourself of this behavior, like I was, like and subscribe so that you don't miss out on future posts. Be on the lookout for a future video that describes the allocation percentages and how to set all this up in the background. If you have any questions, reach out at any time, and as always, stay drilling, my friends.